Hello, everyone, and welcome back to another episode of the Simple Money Guys podcast, where we make money simple for you. I'm Greg, and as always, I'll be joined by John and Ryan. Join us today as we discuss some of the most essential money tips that'll help you take full control of your financial future. If you haven't yet, please give us a follow on Instagram, Twitter, and YouTube at the Simple Money Guys, and please leave us a review on Apple and Spotify podcasts. It helps us a tremendous amount. Hello, everyone, and welcome back to another episode of the Simple Money Guys podcast, where we make money simple for you. As always, I'm Greg, also known as the Daily Investor.
My name's John, at Johnny Finance.
And I'm Ryan, the Money CEO on social.
Yeah, and today we're going to keep it a little casual. We just want to kind of have a conversation with each other, with you guys. We're going to talk a little bit about these hot markets right now. You know, the stock market is at an all-time high. How have you guys changed if you have, changed your investment strategies now that the market's so hot?
I haven't. Yeah, nothing's changed. I'm going to keep, investing, every single month, dollar cost averaging. Every time I make money, I invest it. I don't plan on changing it, if the market or when the market crashes. Notice how I said when. I'm not going to change either. I'm going to continue investing, and I don't change my investing strategy based on what the market does. I'm in it for the long haul, so I'm going to continue investing long term.
Yeah, what's interesting too, we in a previous episode we talked about like the flash crash of crypto, how that was kind of a major thing. Well, crypto's actually crashed even more. If you guys haven't seen it, some of the latest news is that China's trying to ban cryptocurrency and Bitcoin. All the hype from Elon Musk has fizzled out. So Bitcoin is at 50% what its all-time high was. So it's like you can invest into the stock market where that's an all-time high. If you invested in crypto, you probably lost 20 to 50%. So, and also real estate is at an all-time high as well. So it's kind of interesting how all these assets are different, but there's not really a good, good asset class to invest in right now. And I think that's what Ryan was saying. He's just doing the same strategy he always will, and it's that dollar cost averaging approach. I know, Greg, you want to explain what dollar cost averaging is?
Yeah, so, we've mentioned this in a lot of previous episodes. Dollar cost averaging is sort of just, every set interval of time, just investing a fixed amount of money. You're not trying to time the market. You are just averaging in over a period of time. What we do is every time we get paid, we average money into the market by just investing into the same investments, maybe some different ones. And we don't let times like this where, a lot of people are discussing the market seems like it's really hot. Maybe I'm going to wait till a pullback or something. We don't let times like this kind of affect our decisions in investing. I will say, though, I do understand that perspective. We bring up the example of, if there's a TV you really want and it's on sale, you're probably going to buy that TV, right? But we don't talk enough about, while markets are still at an all-time high, you should still be investing. Obviously, when things are on sale, if you have a little extra cash saved up, maybe you can invest a little more. But that doesn't mean you only wait for the pullbacks, because you're going to get caught dead in the water trying to time the markets. I know I made that mistake, when I was younger, for sure.
I think at some point we've all tried to time the market. It's that getting in at the bottom and selling at the top. And a lot of people think they can time the market, but the problem with timing the market is you have to be right twice. You have to get in at the bottom and then you have to sell at the top. So it's super hard to, speculate and guess what the top is. No one really knows with stocks, crypto, or real estate, or really anything. No one knows when the top is or when the bottom is. So that's why we recommend dollar cost averaging. If you're going to invest, just invest a certain amount every single month and really make it automatic. That's what I do with my investments. I turn on automatic investments in my Fidelity account. It comes straight out of my paycheck, and I don't even have to think about it. I'm not watching the stock market news every single day because it's automatic. So just it keeps the emotion out of it as well. So.
Yeah, and history shows that time in the market beats trying to time the market. So the longer you're in, the higher your chance of actually getting a better return. So if you look at, people who cashed out when the market crashed in, April of last year. They cashed out at the worst possible time. The market's, I think, gone up 80% since then. Insane amount. Don't quote me on that, the exact amount, but it's gone up an insane amount since since the bottom. And so if you just left your money in there, didn't touch it, it would have returned double-digit returns since then. And even just this year, the market's returned double-digit returns in just 2021. And so if you're trying to time the market, like you said, John, you have to be right twice. And so it's a loser's game. I mean, people who try to time the market lose. And so when it comes to investing for the long term, just put your money in there, let it grow, and you have the best chance of actually growing that money. If you're trying to time it, history shows that you're most likely going to lose. Math shows that you're most likely going to lose. So my biggest recommendation is just don't try to time. Try to get as much time in the market as you possibly can.
Yeah, and to add on to your point where you were talking about returns this year being double-digit returns, there were a lot of analysts reporting early in 2021 that they fully expected single-digit returns, very low returns this year, below the 6 to 10% average that we typically see from the S&P 500. And it just seems like maybe that's not the case. It does kind of make sense after the year we had last year, which was kind of crazy to see the returns we saw. So it does make sense that some people did expect lower returns this year, but it just goes to show that not even experts, not even analysts from these big name institutions can fully predict what's going to happen.
Yeah.
So
yeah, it's crazy. I know a lot of people who reached out to me like end of last year. They're like, "What do you think the market's going to do?" I was like, "I have no idea." And they're like, has your investment strategy changed because of COVID? It's been a crazy year. I'm like, no, it hasn't. I've continued to invest. 2020 ended up being a really good year in the stock market. And so I was like, I just continued to do what I always did. I bought when the market, I tried to buy as much as I could when the market was down. And I continued to dollar cost average throughout the year. And a lot of people were like, okay, what do you think 2021 is going to do? I was like, I have no idea. Same story. But I'm going to continue to invest and invest and invest consistently. And sure enough, the market so far has returned 15% this year, the U.S. stock market. So if I had been like, you know what, I'm going to wait and see for the market to dip, I would have lost, or I would have missed out on a 15% opportunity, 15% gain right there. So trying to time the market is really a loser's game. And if the market crashes, say it crashes and only a 7% return this year, I'm going to continue to buy. Over the long term, you're going to win by having your money in the market as long as possible. So that's really the best strategy.
And especially in 2021, it's important to not keep your money on the sidelines because we all know inflation is going up. And so I think they said recent inflation numbers are about 5% right now, and it's pretty high in our time frame. So you don't want to have your cash just sitting in a bank unless it's an emergency fund. You don't want to have extra cash sitting in a bank because inflation is eating away at 5%. If you're not getting at least a 5% return, you're essentially losing money on that deal. So you want to be part of the game. You want to be invested. And I actually have a question for you guys because I get this question a lot. People say they want to invest their money, but real estate's at an all-time high. Stocks are at an all-time high. Crypto is just volatile in the Wild West. They don't know where to invest their money. So I'll throw this to Greg. Where are you investing your money currently as of 2021?
Index funds.
Same
S&P
strategy.
500, ETFs. The difference between I guess for me, ETFs and index funds, you can't really automate the ETFs. Mm-hmm. And I guess this kind of ties into a little bit of what, Ryan, you were saying. Something that fascinates me is the psychology of money. And we should totally have Dr. Brad come back on the show to just talk more. Shout out to Dr. Brad if you're listening. The psychology of money is just, it's fascinating to me. And when we were talking about, things being at an all-time high, if I'm, purchasing on my own, if I'm clicking the physical buy button for an ETF or something, and I see that the chart is at an all-time high, there is a little bit of, psychologically, it's like, ooh, like, should I wait? Like, is there going to be a discount? There's totally going to be a pullback.
Yeah.
So that's why I'm a big advocate of, index funds. They do it automatically for you. That way you remove the emotion, you remove the psychology of, having to you yourself click buy and seeing that, okay, I'm looking at this chart, it's at an all-time high. It's just automatically doing it all the time. So, we've said this many times in the podcast, but that would be my best recommendation. We've said, things like S&P 500 index funds, you can't really go wrong with an S&P 500 index fund, dollar cost averaged every time you get paid, whether that's, weekly, bi-weekly, just have it set up to automatically do that. That's what I would recommend for the average person.
I was on a TikTok live stream, and I kept getting that question, like, what am I investing in, or what should I be investing in? And I kept saying, like, the stock market, if you can hold for 10 or more years, the stock market is a great investment. Same thing with real estate. It may be at all-time high right now, but if you're going to hold for 10 plus years, it will most likely be a good investment. And just the one piece of advice that I would give to my audience is that if you aren't willing to hold a stock for 10 years, or you don't wanting to hold real estate for 10 years, I would just invest in yourself. Maybe invest in some skills, take a class, or just invest in yourself so you can earn more income. If you're going to get too emotional in the stock market or cryptocurrency, put that aside and just invest in your skills and try to increase your income as much as possible. I think that's a great way to go about it.
Yeah. I love it. Yeah. And on my end, I do index funds as well. And they're all index fund mutual funds that I can automate every month. And they're all automated. And when I have extra money, I do a manual transaction. But almost all my just finances in general are automated. So, my credit card payments are automated so I don't miss a payment. My investments are automated so I make sure I invest and don't spend the money on something else. And it takes out all the friction involved. There's nothing in my way. It just makes investing easy. And I did a video the other day. I was like, Amazon is so easy, it's so successful because it's so easy to shop there. One click and 2 days later your order arrives at your house. That is how you need to make your investing. Take all the guesswork out, take all the manual labor out, just make it automated, and your life's going to be so much easier. And you're just going to, okay, I invested yesterday. I forget, but it happens every 15th and 30th is when I invest every month. And then at the end of the month, when I have extra money, I just throw it in there. So that's how I do it, and it just makes my life easier. No guesswork. And I found when I was actually doing it manually, I was like, I was really wanting this. Should I just buy that instead? And that's where the psychology of money comes in, and that's where the guesswork comes in, and you could potentially make a bad financial decision. But if it's all automated, you don't. So I highly recommend automating it and doing it into index funds.
Yeah, there's actually a book called Psychology of Money. I think it's by, first name is Morgan. I'm going to have to look that up actually. But I've heard it's a great book. I haven't personally read it. But have you guys read Psychology of Money?
No, I haven't.
No, I haven't, but that's a good recommendation now.
We do need to have Dr. Brad on. And for those who don't know who Dr. Brad is, he's, the world-renowned expert in financial psychology. So you just look him up, Dr. Brad Klontz. He's the GOAT. So we had him on one episode before, and we'd love to have him back. So
yeah, one wasn't enough for that.
Yeah.
And then, John, to build on a point you brought up before, and I want to hear what you guys have done over the last year. You were talking a little bit about cash positions right now. And over the last year, I've actually reduced my cash position to the smallest it's been probably my entire life. And I'm generally very conservative with cash. I like to have my emergency fund, and maybe a little extra just because, I like to be on the safer side of things.
Right.
But my cash percentage is the lowest it has been ever, and I'm majority equity right now. So it's a little scary, but like you were saying, and this is the point you were making before. It's just there's no advantage to holding on to cash right now. So what have your cash positions looked like over the last year? Have they changed or remained the same?
Well, it's funny that you bring that up, Greg, because I was saying that inflation is eating away your money, but for me, like, personal finance is so nuanced. Personal finance is personal. So for me, I've actually had the highest cash position I've ever had, just because I've moved away from my 9-to-5 job, and so having a large cash position allows me the freedom to start this entrepreneurial route and really work on my business without being stressed or pressured to make a sale or anything like that. So it really depends on where you are in life. If you want to quit your job, it's important to probably have 6 months to a year of cash saved up, and that's what I have. So inflation might be eating away at it, but I am comfortable and can sleep at night. So I know, Greg, you've minimized your cash position, but I've actually done the opposite. So it all depends on your certain situation.
Yeah.
No, I think that makes a lot of sense too, and it just reiterates the whole personal finance is personal. I have, you just like one of my roommates, who is a business owner. He has to keep a high cash position. He's recently been hiring new employees, so he has to pay them. There's a lot of different factors that go into business ownership. So it's a little bit different for you. So that makes total sense, and I think it's good for people to hear different perspectives.
Yeah, definitely. I mean, during COVID, there was a lot of uncertainty last year, and so I actually raised my cash position to about a year. Actually, it was probably about 9 months, and I raised it to a year. And so I had it about a year, and when we got through the worst of COVID and things recovered and things started going back to normal in 2021, we actually reduced that to 6 months. So we're also dual income, so at this point, so that helps. I don't think I would go below 6 months, just because I'm pretty conservative. You never know, and at some point I might even go back to a year, just because I like having. I hate having cash. I like having cash too, just because it's a nice comfort. I guess once my net worth is up to a certain point, that cash position is going to be small enough to where it's not really going to impact it that much. But I'd like to probably build it up to a year at some point. But I figured, when the market was, I figured it was a good opportunity to invest that 6 months and get a good return, which it has. But yeah, right now we're at 6 months, and we'll probably keep it there for the time being.
Yeah,
Good
there's
deal,
something
yeah.
comforting about just holding cash, like it feels safe, it feels good, it's guaranteed, it's there. So
And yeah, the more frugal you are, like the less money you spend, the less cash you have to have on hand. So if you spend 20 grand a year, your emergency fund is fully funded at 20 grand. So it differs from person to person.
Yeah, definitely.
But yeah, do we want to get into our simple money tips?
yeah, for sure.
Cool. This is just one of my simple money tips. We're kind of talking about the psychology of money and just understanding how the human brain works. And so I would recommend to anyone who's interested, read the book called Atomic Habits. So I mentioned The Psychology of Money. That's by Morgan Housel. Atomic Habits is by James Clear. It's not necessarily a finance book, but it blew my mind with how influential habits and just daily consistent action is in your life. So,
Yep.
We said about automating our finances, we don't want to have that friction. James Clear talks exactly about how that friction can really mess up your investing strategy and all that. So it's just such a great book. It's probably one of my favorite books of all time, to be completely honest. So I'd
Nice.
recommend, check out Atomic Habits by James Clear. It's a wonderful read, and you'll breeze through it. So it's a great one.
Yeah. Now we have 2 great book recommendations from you this episode.
Bang bang, right there.
What was the first one
Check both of
again?
them.
Psychology of Money by
Yeah,
Morgan
that's right.
Hansel. Yep.
Okay. Awesome. We'll check both of them out.
Yeah, for sure.
Yeah, I think my simple money tip for this week, and it goes beyond investing. This is sort of, I guess, this is going to be a life tip at this point. It ties in because we were talking about how markets are at an all-time high and everything. So some people have approached me worried about investing right now. And my advice would be to remove pride, remove ego, remove that emotional attachment. I mean, maybe not the emotional attachment that's not life advice. You obviously want some emotional attachment to things. But in general, remove the pride and ego and just, stick to a game plan. We said what our game plans were. Yours doesn't necessarily have to match exactly 1-to-1, but create a plan for yourself and don't worry about the noise of what's going on right now if you're in it for the long run. So remove the pride and ego, worry about the long term. That's the most important thing.
What's so funny is there's another book called Ego is the Enemy. I would recommend that one as well. So no, that's a great point, Greg. Pride it can really hold you up and make you make those irrational decisions. So I love it.
Yeah. Dunning-Kruger.
John's quickly becoming known as the book guy of the Simple Money Guys.
I'm gonna put a big bookshelf in the background and show all the books.
Actually, I do wonder, like, I'm sure, to the listeners, we each have our own personalities and everything. I wonder how we each get characterized at this point.
Cool. I guess my simple money tip is if you're a new investor, learn about it first. Take your time. If you need to dollar cost out, if you have a large sum of money that you want to invest, maybe it's not best to invest. So 70% of the time, you're better historically to throw it in at once, and you'll outperform breaking it up, which is dollar cost averaging. But the psychological part of dollar cost averaging, breaking it up, can be a huge beneficial factor to you if you're a new investor. So say you're a new investor and you have a lot of money you want to invest. If you invest it all and then the next day, the next week, the market takes a crash, you're not going to want to invest. You're going to shy away from investing. And that psychological part of that is going to be way more detrimental than if you dollar cost average and you have a lower return, but you still invest over time. So my biggest advice would be make sure you factor in the psychological part. If you have hesitations, take your time, learn about it, understand about investing, and if you need to break it up and dollar cost average, do it. Do what makes you feel comfortable, and make sure, because I want you to keep investing beyond that initial start, because that's how you're going to become wealthy. If you stop after that or cash it out, then you didn't really achieve much. So that's my biggest advice, is just do what makes you comfortable and will make you want to keep investing long term if you're a new investor.
Yeah, for sure. We've discussed a lot of psychology and money this episode. And yeah, I was speaking with one of my financial advisors once. We were going through some research, some literature, and as you alluded to, historically, lump sum investing has outperformed dollar cost averaging for large sums of money. But if you are to dollar cost average, the greatest rate of return or the greatest outcome has historically been taking that large sum of money and dollar cost averaging it over the period of 6 months. But I think anywhere between 6 months to a year, whatever you're comfortable with, makes sense. But once you
6
start
months
to really,
is a sweet spot if you do decide to dollar cost average.
with a lump sum of a large or non-lump sum, but having a large amount of money and you don't want a lump sum. 6
Right.
months seems to be that magic number where you're not waiting too long and missing out on all these gains, but you're extending your exposure in case something happens.
Yeah,
Very nice.
Exactly.
Yeah, so I think that wraps us up for this week. As always, we are the Simple Money Guys, making money simple for you. I'm Greg, also known as the Daily Investor.
My name's John at Johnny Finance.
And I'm Ryan, the Money CEO on social. Thank you so much for joining us, and we'll see you again next episode.
Thank you everybody for listening. As always, give us a follow on Instagram at The Simple Money Guys, subscribe to us on YouTube, and be sure to tune in because we have new episodes coming every week.